All right. I don't know if anyone's in here, but I saw a bunch of retweets of the announcement, and it's not a scheduled event, but we needed to finish off the beginners basics, so this was a good opportunity to do that this afternoon, as well as take a look at a couple of interesting things. So I have on the screen now. Obviously, this is SPY today, and this is what you would call a mode 1 day, which is a squeeze. Basically, after the initial open occurred here, right here, you had a raise, you had a shakeout, then it came back to Model T. After from here to here is a Model T that we've exhaustively talked about. You'll get sick of because we trade off that quite a bit. But that would have been a wonderful entry point, not only because it being a Model T, but because of where it occurred. And that was right here at our blue line, 200 EMA, was a great opportunity for people to buy in at that level. And if you only traded SPY today, you would have done exceptionally well. And so this is a very common in a mode 1 day. So you have, there's four basic patterns that occur on your dailies, and this is a rare one, right? We all love them, and when they happen, but they're more rare. And it's a mode 1 bullish trend day. You have bearish trend days that we saw earlier in the week. Yesterday, we had I would consider yesterday a sideways. Some might say it was choppy, but I would say it was sideways because if you drew your trend lines on yesterday, you actually had a pretty fair initial girth between the upper level and the lower level, and then it slowly got tighter and tighter throughout the day. And so that was more of a sideways pattern that occurred. And then obviously we pointed out on Twitter that VWAP was very key yesterday. And boy, was it, it just could not break above VWAP. But that's only for an intraday pattern, right? Look at today. It broke through that. The 433 level was resistance all day yesterday. It became nothing. And that's how markets work. And so that's why if you're using intraday charts, you don't marry any of the data that you see on an intraday chart because it's only a day. And so yesterday was what I would call sideways. You could also get into a choppy market, which goes, doesn't have those ranges. It has just up, down, up, down, up, down, up, down. And so it's nothing is standard on there. Yesterday was actually fairly tradable if you were using the upper and lower, and it's more of an advanced strategy. If I drew a line on yesterday from the upper end to the very first bottom and then to the next top, and it was a lower top than the previous one, go ahead and draw a line as if that's going to continue throughout the day, and it actually did. And many times on days like yesterday, it does. It just continues the narrowing of those trend lines. And so the way that I would trade those is some people are like, well, I'll buy puts when I feel like I'm at the top of those, and I'll buy calls when I think I'm at the bottom of those. And that's fine. You can do that. But I think the most successful way to do that is when you have that trend line and it's coming up towards the top of a trend line, for example, of that descending trend line yesterday, you would sell covered calls, sell the premium, in other words. So you don't own SPY, but you would sell SPY calls. And the reason that I like doing that is because not only do you have an easy out if it breaks through your trend line that has been drawn, then something different's happening in the day instead of the sideways action, right? But what I'm doing is I'm selling premium, and as that goes down to the lower end of that, the premium decay on those is going to be much quicker than if I just tried to time perfectly when the trend reversed back to the downside. Similarly, when the stock is down to the lower part of that trend line yesterday, then I would sell puts, naked puts that were expiring, right, and sell those right at that trend line or the next price point down. And then as it bounces back to the upside, you're making money. And then you just choose at some point after I would say after the 75% of the way back to the top trend line in that instance, same thing, 75% down towards the bottom trend line yesterday, you would be exiting those just in case you get a Model T or some type of reversal that happens that still keeps the sideways trend, but it wants to erase the ability to make that trade successful, more successful. So I would be looking to do that. So today was a mode 1 day. It was a mode 1 bullish. So you have bullish, upward, mode 1 trending market. That's what we had. You have bearish, mode 1 declining market, and we had that earlier late last week. And I had signaled that one that I would expect that to be within 3 days. I know on the forum I said within 3 days expect the markets to begin to sell down for at least a pullback, and that's what we got. And it started with a negative day on there. So then you have the sideways action that was yesterday. Then you have choppy. So today is a mode 1 uptrend day, and again. For you that just joined, and you'll see it obviously on the recording. When you have this, and this is what I was looking for yesterday, by the way. This is what I was hoping yesterday would be when I said, if you get this right here, which was the up, down, and your midline is right here, and it came right back to the midline, Model T of this and here, Model T exactly, by the way, that would have been a perfect entry. Then you had a squeeze that was very evident after here, if nowhere else. It was going to be a squeeze day where they are not going to give the bears any opportunity to get out. I'm in a losing trade. Maybe I'll wait for it to come back down here where I entered my puts or what have you. And they don't ever let it happen. They never let you get back out. This got close to Model T. I didn't calculate. Nah. That didn't even make Model T before it reversed, which again, on an upward mode trend day, generally you don't get a lot of Model Ts after the initial one because the squeeze is on. And so all day long it squeezed. And then when you got to that last hour, which is, the last hour, what's going to happen? People that have been making money through this squeeze, just enjoying this, they're going to start taking their money out. They're going to take the profits. And so the bulls didn't want to really let go, relinquish, but you get this back and forth action. You pretty well know this isn't like a normal day where I would call it a lotto day. Lotto day, things just go wild. But this was much more controlled. Look how small these candles are. I mean, these are very, very small. And it's a very controlled squeeze that goes on until that last hour. Then it went into the sideways chop. And then you had a lot of, look at this, just a whole lot of profit taking. People were like, that was good enough for me. I want to pull up another, and we'll get into the slides of the basics here in a second. But just since this was a great day, which I happen not to be here for, that's how it works. I was here yesterday, and then we get that sideways garbage that I was like, this is going to be a sideways day, and sure enough, it turned into a waste of time. This is the SPX, and if you'll see, Model T was 43.88. Actually, it's a little bit less than this. I couldn't get my arrow to pull down exactly where I wanted. But the moment that you spot that this is a squeeze day going on the SPX, your eyes immediately, and you should already have it calculated every day. At the end of every day, even if you don't know, are we going to continue to trend down or not? What you do at the end of every day is you take the high that you had here. You take which was what, 44.48. It's over here, by the way, for you that need to see it. but it's 43, 44, 48, 47. You take the low of the day. So yesterday you would have done, or 2 days ago, you would have had it right here and you would have figured out what Model T is and it would have been up here somewhere. After yesterday, you add this high to this low and you divide it by 2, and that comes out to about 43.88. We got within, I think, a point and a half of Model T. So your eyes and your game plan should have been going into the day, and especially when you see it could not break down early to even try to shake people out here. The only shake it did was just let me go to the minute chart. Was a very quick attempt to go down and then immediately back up into Model T, and then off we were to the races. So even if you didn't catch this Model T here, by here, you pretty much should be able to start seeing that it's broken above this. So you've broken above all of the resistance. And by the way, that was, you look at after yesterday's open, it was nothing but resistance all day long. But it broke above it here. It dropped back, it came back, and then it came back and retested this resistance, broke back above it. And we talk about that all the time. Once resistance is broken, it becomes support. And that's what happened. And so that should have set your mind. If in our forum, we'll have live trading on days like this. I'll be much more active in the early part of mornings, especially. Sometimes all of my trades happen within the first 90 minutes in a day, and then you go do something. You make your money and you go do something. So I could have left this today. I would have left this and wouldn't have had any issue leaving this to only come back and check on it or have my alerts for profits up here somewhere towards Model T. That's my expectation, was once you have this trend day, the mode 1 day going on, my eyes are going to be on that Model T. And so we got real close to it, but you would have been selling into that anyway. You wouldn't wait for it to hit it on a big up day like this. You take your big profits and you move on. So you also have this gap right here, obviously, which is down at 44.07. So if you start seeing follow through tomorrow, obviously you're going to have to contend with the gap, or the Model T does get met yesterday, probably going to have some resistance. It happens to coincide with this high right here. And also if you come here, there was some resistance along this way. So not a whole lot, but it may run into that with the Fed being the next day and other data. I'm not sure how much upside. Maybe we do have another strong candle upward. But if it does break above this Model T, then yeah, your eyes should immediately go to this 44.07 as kind of a natural next fill that will occur. And then after that, then we would be basically making liars out of all of the people that said this is the end of the road and now it's a bear market. They would be proven wrong. And I know that there's a lot of big bears out there that have made that claim as of before last week again. So I say let price action dictate what we do. We can trade what the market gives us. We are not concerned about those macro predictions being right or wrong. If I make them, I'll make them along with anyone, but they're not gospel. All right, they are just me taking a look at what I'm seeing, and I may give some macro forecast and outlook. I mean, my personal outlook, I think I told in the forum, was 4,500 on the S&P, SPX. We're at 44.50, and I'd given that way back. I mean, way back, and when I said, and you saw the tweets about markets love excess. Once the bulls had the bears on the run, they love excess, and that's why you would be very bold in your trading during that period. We'll have other periods like that, so don't fret that the service is getting started after just this wonderful, great period here of time. And again, we made a lot of money off of the calls that was being thrown out on Twitter, but we will be able to do a lot of this all the time, but we let price action dictate. We're not going to be married to our predictions because they are predictions. Price action will tell us the trades that we're going to take. So anyway, that's kind of the view right now that we have. I mean, obviously, if you look at your daily chart, I'm not sure, if we're going to end up with this type of a pattern here. It's kind of similar. We had broken up to a new high. We broke out from this level here up to here. So same type thing. We came down and then we shot back up and then went into kind of a sideways pattern to figure out. And of course, these pennants here, I mean, we watch these very closely because when they break, it broke to the downside here, then that gave us our direction that we wanted to trade. But these pennants are forming all the time. Sideways action, your first instinct should be, I'm looking for a pennant. So I'm sure that there's pennants being formed when there's sideways action, and you just figure out where they're at, and off we go. So right now, if I were to come out here, I would maybe, right now, you would have something going on like right here, right? So you got this channel here I would probably raise this up a little bit here to the breakout point. So it would be a little bit flatter, but that would be right now. You've got a pretty good pennant formed that is going to dictate the next move. So again, breaking above this would be my first indicator that some more upside is coming. So, and again, as with everything, that would be closing candle. It doesn't, if there's a wick that jumps up here tomorrow and then it falls back within this line here, this trend line here, then guess what? You just fell victim to a false breakout. And that happens quite a bit. So we're going to have to be very cautious. Today was the day that you would have been like really, really active. Once you spotted that trend occurring, you would have been bold buying the dips throughout the day. And then when you get to that, I would say 15 minutes to 20 minutes before the 2 o'clock hour, the last final hour, be taking profits because it's just common sense that people are going to take, big companies are going to take profits a lot of times in that last hour, unless it's a full on engaged wrecking. And you would have a much more open wave. And let me explain that. Let's see, get rid of this. Did I get back to open that up? So instead of these tight bars, you would have had much more like these, right? You see how much bigger these are, and they're just shooting up and almost like this. You would have had this action throughout the day versus these tighter bars. So the tighter these bars got, it was so obvious that I got in at about, I don't know when my first tweet was. It was this afternoon, 1 o'clock, 1:30. But I mean, you could just see the squeeze was just going on, and they were not going to give a breath until into this 2 o'clock hour. And then money started being taken out. This, by the way, yeah, that's big red numbers, but it really doesn't mean anything. These are a lot of funds that had determined sells, and so at the close they settle, and that creates the imbalance at the end of the day. Sometimes that imbalance is bullish to the buy side, sometimes it's to the sell side. So you had some sell side imbalance today, but I mean, in general, if you had put 1.5 million shares, 2 candles of 1.5 million shares plus anywhere in here, you would have broken this immediately. You would not have had this trending up and buying the dips. It would have broken it and pushed you way down into here. But even up at the end of the day, it didn't break it down that much. So it didn't wreck anything for tomorrow. All it did was clean up, and some people probably made some pretty good money that had a predetermined sell into the day. Okay, so that's kind of what happened today. It's my favorite day. It should be your favorite day. The conversion of that, if I looked at the converse side of that, would be the dreaded H days on the sell side. I love dreaded H days when I'm looking at puts and then shorting at the every time that there's a rise, I want to short into that on those dreaded H's, and each time those dreaded H's confirm, you're in great shape. So I covered dreaded H in the basics. If you need to refresh on that, it's in the initial seminar. All right, so let me now go. All right, so a cup and handle pattern. And I just want to finish these patterns. They're very tradable, so we want to make sure everyone has the basics of what to look for on those. Here you have it's more of a saucer, I would call this. It's shallower than what I like to see in a cup. This is a very bullish. The deeper this goes and circles back tells you how much buying interest the demand is versus supply. So this shallower one, it's definitely gives you some indication, but you notice how it had this sideways action of back and forth, back and forth, back and forth. This shallower one, I'm always more cautious. Notice the shallowness there versus the depth of this one. I've been known to trade these, but I'm much more cautious. And yeah, you could have had a little bit of success with it, but it only got up to right here, which basically completed the saucer. And then notice it went into a dive. And I've been caught in these. Every trader is going to be caught in these. That's part of the business. The only difference is, when to stop out. And so the moment that it would lose the midline here, I'm going to be out. If it's a loss, it's a loss. If I had gotten in anywhere, along the way, maybe break even. But if it's a loss, it's a loss. I'm not going to risk dollars waiting for something to rematerialize that is now broken. So I did start, and I do start drawing my trend lines when I start seeing this action. So I'm going to start drawing some trend lines. And each day, by the way, I had drawn like from here to here, here to here. The next day, I went from here to here, here to there. And then we had ultimately up to here. So I maintained that trend line as the final one before it broke down. And then once it broke down, I used the trend line from here just to see if there was going to be a crossover on a cup and handle. So when this cup formed here, you notice it immediately shot up. It broke out above the 3-day. And you'll hear me talk about 3-day breaks all the time, but it broke above the 3-day. It went up the next, and then it comes back down and it retested, the breakout. And this is our favorite time to buy, is right here on the cup and handle, is on the retest. So in your notes, you would just put, once you have broken above the left side, which is about right here, you draw a line or know the number, whatever the number is. As soon as that number broke, then that's not when you buy. You wait, let it break out. Generally, it's going to, the most of the time, it'll come back down for that retest. And so this retest is where you would buy, and your stop would have been below this right here. But what you're wanting is it to hold these levels right here. It did. It had a little bit of a blip below it. And then this candle that shot straight back up as an engulfing candle of this whole construction that had occurred, that you should be very confident now in your trade. No matter, just go ahead and commit to the trade at that point. Now, doesn't mean that you're not trimming, but if I had a 30, 45 day call, let's say out to here, 30 to 45 days later, I don't care about the ebbs and flows, even though it came back down to the trend line, and I have my trend lines drawn. It came back down and it retested again, and then it immediately was back up. And this is over a weekend. It gapped up on a big day, came back within the range, and then continued starting the range always on an upward trend. So at some point, you're going to have to take your profits along the way. This would have been a great trend move up in towards the top of the trend line, and then add if you're that type of a trader, you could add. But this one here that broke the upper trend line, that would have been when I would have sold my calls. Okay, I don't remember the Nvidia trade, but that would have been the day that had I been trading Nvidia, this break above would have been where I sold. And if you notice, it broke above and then it fell back down below. And then the next day it was opened up around there, held for the majority of the day on a tight day, and then it started back down. And then it took a while, but it then trended to the bottom side of the trend line. Whether you decided to make another trade here on an upward trend that's been established, I would say that's a pretty fair trade to do so. And of course, you would have gotten rewarded with, I did not get this, so full disclosure, I didn't get to enjoy this beautiful AI gap into the stratosphere. I've enjoyed those before, and they are quite fun to wake up in the morning and see that your account is up, however many thousands of dollars. It's pretty cool to do that. So I'm looking forward to people experiencing that. If you're on the right trend stocks, eventually you're going to get some of those. It happens. And so we've had quite a few of those things when we wake up and it's Christmas time in July. So that's cup and handle. There is some more nuances to it, and I'll get into some of that in the more advanced seminar. But in terms of the pattern, this is a classic cup and handle right here. Break up above, retest, shoot back up. Now you feel good about your entry. Even if you entered this day, you're committed to it unless this structure down here gets taken out, which it did not. Okay, this was trending upward even on these bad days when people are, we have a sell-off going on, you're still on the uptrend. Okay, head and shoulders. Obviously, you've got this happens again. All of these patterns happen daily on the intraday charts. They happen on the daily charts. They'll happen on a 4-hour chart. They'll happen on a weekly chart, monthly chart even, and occasionally you can spot some on a yearly chart. But the head and shoulders is a classic exhaustion end of a move up pattern that occurs. So you have the wedge that's occurred upward, and then you end up with this parabola shape that brings it right back down to that last breakout here, and it'll come back down into that, creating a head. Once it breaks then below that neckline, I like to see the full, this one right here is tradable in the way I look at things. But this is ultimately what you're looking for to be broken for a bearish signal, not just a pullback, but probably a pretty significant sell. And we did have that from February. This was the end of the, this was the start of the major downtrend of the macro market. And so it showed itself in a day with this pattern. And then I don't know if I have the next day. I don't, but that's in June. So this pattern, once this broke this neckline, so you would just draw a line across here to here. And eventually that, if it gets broken, then you go with it. And again, you want a closing candle. If it's on a daily chart, I don't wait for a closing candle. If it's on an intraday chart, I wait for a closing candle below this. Even though sometimes these candles can be really long on an intraday chart. They'll look like I'm missing out, but no, wait. Because there has been times where it'll wick all the way back up and break this pattern to the upside. So even though it's a head and shoulder, it needs confirmation. It does not say that it is guaranteed to go down. It suggests that there are sellers that are sitting on the bid and lowering that bid to be getting out at what they perceive to be highs. This next one is in June. This was June 12th. And if you go to June 12th to the 13th, you'll see that this one here broke down below this. So you got left shoulder, right shoulder. Here's your neckline that eventually gets formed. And when it breaks down, then it retraces this whole move. Some people would say, really, I want this to be broken before I would be fully bullish. I would endorse that. What I would do is use this neckline break down to here to trim, anticipating a Model T, if nothing else, bounce back up. But once this is broken, you got a change of structure that's occurred in the markets. You notice this heavy volume here that occurs. You've got wicks on these this time, showing that it's major selling that was sitting there, pouncing on those bids that were coming in trying to break it through. So they were successful to my left side. You know, see these wicks that was starting, the selling was starting, but they weren't putting their foot down yet. And so up until this point, then it was big volume, and they were like, you know, you shall not pass. And that was how that would look. Pennants and flags, again, I showed you some of those earlier, but all you're doing is every day draw trend lines and see if you have any, you know, if your sideways movement that's been going on, you should have a pennant that is beginning to form. And as soon as I have 3 points of reference on a trend line, and this one doesn't give me a very good one, I'll try to find one that does. But sometimes what will happen, this is an intraday chart, and we had one yesterday that we drew this same type of thing. This is from 523, a day much like yesterday, right? Same type of day. You had VWAP, what was kind of the regulator for the day. It never could get above very much. It couldn't get, you know, it didn't break down too much. It just held around it. Yesterday was a little different in that VWAP was full on resistance. Once it broke down below VWAP, it could not get above it. It just kept hitting all day long and couldn't break above it. But so if you drew these trend lines though on an intraday pattern, you know, I would sell premium up here. Anytime that you hit this or flashed and wick down below, second that it came back down below, sell premium and just count on that to be a downside. And then once it broke through, sorry about that. Once it breaks through, it came back and recaptured, wicked back down, and it just never could do anything. And a very frustrating day because you're anticipating, right? You want to see a breakout one way or another because then you could trade. But it makes it very difficult. And so you got to be disciplined on days like that to either sell premium or put naked puts if you have firm trend lines, or sit it out. Don't do anything because you'll get yourself in trouble. You'll start losing money and then you try to make it back. It's just bad psychology. This was a day where pretty much the same time we had, you know, I don't have the previous day on here, unfortunately, but I was looking at the overnight on this, and I tweeted right here at this point. This is where you would have to move the day back up, and I was signaling off, if you pulled up a daily chart, there was a line that went right through here, all the way back. There was major support on SPY that was trending upwards. So you had on 517, right? As everyone knows, we're in the middle of a move upward in the markets. Well, as soon as this hit this level, I tweeted that this is where you'd want to begin the move back up. Some 413 SPY expiring calls on the cheap would be what I would buy, and that would have put you about right here. Sorry, I don't have the right side. Well, those came, and as soon as VWAP broke, it tried to retest VWAP, and then it just took off. And I think we ended up at 416, 417 for a really profitable day off of this trade. So I call it lotto, even though I really felt pretty strong about it. And generally, lottos are the last, hour and a half. I consider anything that is expiring to be a lotto because you don't have time to sit around and wait 3 days, 4 or 5 days for a trend to adjust to your liking. It has to be right now and it has to be right. So anyway, that's something that in the advanced I'll show how this setup allowed me to send this out and how you guys are going to be able to make some really good money on days. These are very rare days. Yeah, I think someone in the forum said, "Can you explain how you knew that was going to occur?" And again, I'm not saying I knew it was going to occur. I said that this would be the time if we are going to move upward and this is going to hold, this is the time you would buy those calls. So anyone that had bought with me on that, if it failed, if we had dropped back down here, you would exit, and it didn't materialize. And in fact, yesterday would be a perfect example of that. I said very nearly the same thing yesterday, didn't I? If you go back and look at the tweet, I said you might want to, on this pullback, buy some calls. And because this could be a mode one trend day. Well, we were one day early and we did get an upward move, but it quickly capped off and we ended up in a sideways. So just because I tweet it doesn't make it gospel. It doesn't mean, well, Randy's always right when no, it's the highest probability of being successful of a trade. That's what I set up for people. If it fails, your losses are minimal because it is a easy knowledge of when you don't wait and say, well, let's just wait, let's just wait, let's just wait and see. No, it is a concrete number that had to hold for this to be a successful trade. And it did, and it Model T off of the low high. So late people could have gotten in onto the trade. But it was a wonderful trade. I think it got us 240% on the runners. We took 100%, and then we held on to our runners, and they got 240, 250%. So it was a really good day for that. Okay, support levels. How to spot support levels. I mean, you have generally your stocks are going to very rarely be able to range for long sideways. They'll always either be losing or they're going to be rising slowly. They'll deteriorate into support or they'll rise into resistance. And so here you see that it's just been deteriorating. This is target. When I was waiting to tweet with great anticipation to buy target. And I'd already put a watch out there saying, look, it's going to be a stock we want to be in. But this was what I was looking at. This is a 15-minute chart. So I'm looking at target not for a day trade. I was looking at target for a trend reversal trade off of that downtrend that had occurred, the big breakdown that created a gap. And that gap is about 144 is the closure of that gap. And so at 126, this started happening. And this is when I tweeted, I'm buying my target calls. And I bought expiring 130 calls. I bought 144 calls, which was Model T, and I threw in some 138 calls. And so you'll notice later, as I'm saying, I'm going to sell all of my 138s. Well, we were at 138, and I said I'm going to ditch my 144s because it couldn't break above, and so I'm like, Model T's not happening. And I didn't want deterioration to hit those. So we just went ahead and exited. I sold shares. I sold covered calls on shares. You'll see all of those in the tweets. So I was managing my trade, okay? And it was a multifaceted trade. It wasn't just, hey, let's buy a few shares. And so, but I had all of that action going on, which required a whole lot of management going on. So I may speak to only one aspect for some of you, because some of you may say, I only want to try, to do the shares. I want this long term in my 401k. I want trades, that'll make me some good return short term with little risk. Well, this would have been the trade. And this 15-minute chart gave me the confidence and the information that I wanted to see. You had the acceleration. Imagine what the 1-minute charts look like, because this is a $2 move into the low, 250 move from right here into the low. $2.50 over about an 8-minute period. So it accelerated the down move. And I always talk about, anytime you've had a stock that's just been slowly trending down, if it's a 1-minute chart, then on your 1-minute chart, you should see an acceleration, even if it's only for a few minutes. You should see an acceleration down. That's when you would start looking for your entry time. Now, a lot of times what will happen on those acceleration points down is they'll go sideways for a while. That's what occurred here. This is a 15-minute chart. Imagine what this looks like on a 1-minute chart. That's when you hear me saying things like, I think there's a pivot forming. So the 1-minute charts look grossly different than this, because it would have been line, going up here, creating that line that I put in the middle. A lot of times you guys see, I'll put a line in the middle, and then I'll have the lower ranges set. And as soon as this line gets broken after this period down here, you know that you've confirmed a high probability trade. Kevin, if you're one of my people, text me. I can't talk right now. Anyway, this is what we spotted. This is when we were buying. It happened to be the low for Target. Hey, I told my preacher to buy. If I'm telling my preacher to buy Target, you know that I have high confidence. So I told him to go, hey, just go buy Target. And he did. And he did very well on that. So that's Target. Here is another way that these bottoms can look. Okay. You get these wicks. And so you see these wicks that start forming that are real big. You have wicks all the time, right? There's wicks. Oh, Randy, there's a wick. And here's wicks. There's wicks everywhere. But when you start seeing this pattern of you not only had your acceleration, you have it here, no wicks. You had it here, wicks. Okay. You had wicks. You had this green candle here. You had a wick again. That's telling you structure is forming of buying. It happens to also coincide with right here. So you're looking backwards, and these are 1-minute charts. This is telling you that these numbers, the buys that created these bottoms, temporary bottoms, even though they went lower, this was trying to break down the structure of this support. And every time it tried to break it down, it kept closing back up. It kept closing back up. It got real close right here to closing below the lows. And right here, I think it went 429.92. So no, it closed back within it as well. And so as soon as this occurred, it broke back up and then shot above this area, which was great, but I want to see it above VWAP. And sure enough, it did. It popped back above VWAP, and we were off to the races. So these support structures, once you start spotting these, they're very tradable. And that's what I want people to see. And when we're doing some of these live, it'll really plant this home, because it does look a little different on the chart when you're seeing it in real time live. And I get that. Here's NEO. When I was telling everyone NEO is reversed, this is a 4-hour chart. Again, I am looking at, no, still, hang on guys, still. There we go. NEO, I'm looking always, when I'm trying to look for my entry points on a stock that I've determined has reversed trend, and I was 100% convinced, otherwise I wouldn't have tweeted it. Otherwise, people have a really fun time sometimes throwing up a tweet saying, well, you said this, right? So I try to be accurate when I'm going to make those predictions. They're not always right, but generally they are. Odds are, if I tweet something like that, I'd say a good 85 to 90% of the time, it turns out correct. And if you can't make money 85% of the time being right, then trading's not for you. So this is a 4-hour chart, and I always draw backwards. I was looking at the 15-minute chart, and then I decided when I had seen this on a 15-minute chart, I went to the 5-minute chart, and then I went to the 4-hour, and I saw this, okay? And then I knew that you had major block buying going on, okay, on these chart levels, okay? This right here is a classic bottoms up chart buying, because what's happening is you have these big, and these are big wicks, right? This is over a 4-hour period moving 70 cents on a under $10 stock. That's big moves in a 4-hour period, okay? To be able to do that and then do it again, that tells you, and you notice that they raised, so they wanted in it. The demand was there, because you always see this raising of their bid. They moved their bid from here to here. There was one more I didn't incorporate into this slide. There was one more that occurred right here that completed the sequence. I was already in. I had bought my leaps. I told everyone buy 2025. I went with the $7.50 and $10 leaps. I suggested that you could go as high as $12.50, I believe, on those leaps and be fine. That they would make money. But anyway, that was NEO, and this was their lows reversal into the move upward. All spotted because of confirmation of the daily chart, which I don't have my daily up here, but coinciding with my daily chart, I was already looking for my entry. This is how I chose my entry, was when I saw the pattern. And as you know, we went and did our initial gap fill, and it was a great trade-off there. SPX, we talk about a lot of times. I draw these lines. This is a 1-minute candle, but I'm drawing lines all day long. You can always eliminate them if they don't hold true. But I started drawing this line, and just you see I broke it right here, and then I drew it again. So I drew this because every time it went down, the wick down, and then came back and closed, it was holding up above this trend line. I don't have VWAP open on the SPX. If I looked at my SPY, this is pretty much on VWAP. So we shot up again. We made a new high, and a lot of people are feeling pretty good about that, but there was still some resistance at that 39.90 level I would like to have seen cleared. It couldn't before it shot back down, and then it fell, and it broke down through VWAP with a closing candle, okay? This candle closed below, this candle closed below. What happens when resistance or support gets broken? It becomes resistance, even if it's short term. This is only on a 1-minute chart, so it can last for the rest of the day, like yesterday. Once it broke below, it couldn't muster energy to get back above. Neither could it on this day. It broke below it and became resistance for the rest of the day. So pay attention to these. Just draw your support lines. Draw this resistance line, right? Go ahead and draw across here. Even if it's broken above, at least you have a point of reference that you're going to range and say, if it runs above that and breaks that 39.90, well, then I can start looking for trades to the bullish side. But once it broke down back below, I would have been looking for the put side, because generally 3 strikes and you're out. One time, third time it tries to break down. A lot of times you'll see it break down. Yesterday I made a trade that didn't work out. That was I bought 25 calls because it had visited the VWAP line for the 3rd time to the upside, and that same rule applies, and that is, you know, a higher percentage of time, if it revisits VWAP to the upside the 3rd time, it'll break it back up. Well, it didn't. It couldn't muster it, and I ended up, I think, got 4 cents for my 10-cent trouble on those 25 calls. But so it didn't work out. That's a lotto, and that's the way those are. But yeah, once it breaks, it becomes it. If I had an AMD slide that really was great on that at 92. Uh, Here's SPY showing you the same resistance level on a 4-hour candle. So again, if you're looking at daily, you want to keep an eye on your daily trends. Bring up a 4-hour candle besides your daily candle. Bring up your weekly candle. You should know your ranges weekly. If you've broken out of your weekly range to the upside, that's very bullish. If you've broken down to your weekly range or to the downside, that's typically very bearish. And so watch your weekly trends, especially Wednesday forward. I mean, it's only Tuesday, so they don't have as much merit. But Wednesday forward, they would. And so I look at the weekly, I look at the 4-hour, I look at the 15-minute for my daily type of trend trades. For my breakout trades that I'm looking just to trade maybe calls intraday even for a breakout. Then I would look at my 4-hour, 15-minute, 5-minute, and 1-minute. So those are the adjustments that you make just depending on the time frame of your trades. So you may remember the AMD trade that I was basically giving a play-by-play, almost like a broadcast booth. Let's see. So I had a resistance level marked up here, and I noted a lot of resistance that was back this way on the 4-hour chart and the daily chart. And so this was the actual first trade that was made, was shorting AMD. And this was a real time where I said I'm shorting at 127 with a stop at 128. I was going to risk it $1 in case the candle busted up above it and then came back as a wick. I was willing to risk $1 on this trade. So I shorted it. It happened to just immediately start coming down, which was great. It couldn't reach Model T on this wave. It only got to here. It couldn't get to here, Model T. That's a good sign for bearishness. And it went into a straight dive. I have a support level drawn down here that was off the initial breakout backwards here. If you had a 4-hour chart, again, you would have seen that there's support level. So I looked at the 5-minute chart as well on this, was pointing this out. And I said, look at AMD working that 124 support level. If we move up, then Model T on that is likely 125.49. I was getting out. I'm like, I'm covering, I'm getting out of my short. I bought some calls, and I said I can get creative on a Friday because your options are so cheap on a Friday. It adds another layer of strategy that normally you can't have. I could have either held on to my short and bought some cheap calls to protect my short position. That was, I'm up what, $3 on the trade on the short, so I have $3 that I can play with. I could buy some calls 50 cents higher at 70 cents or 60 cents, whatever they were at, and had a 240 profit guaranteed just in case this turned into a really bad day. But with this structure here of support, I decided just to go ahead and exit most of them. So $3 gain on the short, knowing it's a support level. I'm simultaneously taking 125 calls for a trade. And I think I had 1,000 shares short, and I held 200 of them short, just in case we had a complete collapse. But I bought 15. I didn't buy a whole bunch, but I bought 15 calls of 125 calls for 17 cents. And sure enough, it came all the way back up and busted through Model T for a nice trade on the call. So I think I made 80% of what I made on the downside on the calls. So it was a great day, and able to show this real time how these supports run. So on the advanced trading, I'll be able to share how this structure showed backwards of making these type of decisions and being able to go out in real time and tell people this is happening, this is why it's happening, and this is why you should feel confident making a trade here. So it's all about confidence and opportunity in these trading periods. The last structure I want to share for today, and this completes the beginner's basics for seminar, is a Darvas box. And a Darvas box is simply a period of time, and this is a daily chart that we're looking at, where a severe sideways pattern develops between the bulls and the bears, not giving ground. So there's no trend going on up or down. Microsoft went through one of these a couple of years ago that was massive. And when it broke out, it was a 90-point run. The longer the Darvas box, the greater the breakout potential is. So this was, I think this is HD. This is, by the way, this was our first time when we traded HD up into the 305 or 6, I think it was 306 level. Because what do we say? You know, a $300 stock that breaks 300 is generally going to go $5 to $8 above that price. And so we were waiting for this Darvas box. I didn't show this on the Twitter. I just told you when it was happening. So I said, I'm buying calls. And the reason I was buying calls, though, is because it broke the box. So it's not rocket science. It broke the box. And I didn't do it the day it broke the box. I waited, just like here, this broke the box. I waited for the retest, and then it needed to have a candle close above it. This one broke above again on the next day, and I was feeling like maybe this is happening, but it came back down within the box again. No trade, no trade. This day here is the day that we entered the trade, because it started this day and it rose up and it had a closing candle right here. We were buying calls into the close. It was a late buy, very unusual. I usually like to buy my calls earlier in the day to get a move, but we went ahead and bought because the signal had been given, and we went ahead and went with them. And it shot up almost immediately. That was one of the ones where I think the payday was a day to 2 days later. When we were getting our payday off of it. But the Darvas box is a very strong sideways pattern that once it breaks, there's generally a lot of conviction to that. So Darvas box, write that down. You'll see a lot of examples of that when stocks aren't just trending upwards or downwards. If you start seeing a sideways pattern, you know, it's good to know. If I have a call, let's say that I had entered, you know, whatever was happening, I can't remember back this way, but let's say that it had been on an uptrend and it's pulled back, and I'm thinking, hey, this is a pullback, and I'm going to buy the pullback. And maybe if I had some structure over here to buy some calls, and it looks like I'm doing great. Now, I would have trimmed here on a great move like that anyway, but let's say that I held the rest and I fell back down. I still would have held my trade, because I'm not below my entry, right? But then what happened is it went into this stinking Darvas box. So if I happen to have been sitting on calls, they're dead. They're absolutely going to die a miserable death. And so you do not want to be caught in a 45-day out call that turns into be a Darvas box. So you want to spot it as quickly as you can so that you can get out of Dodge. Okay. And more importantly, you don't enter a trade on that stock. There's plenty of other stocks to enter. You avoid these like the plague, because you don't know how long they're going to last. And it's just very bad. All right. Okay. So here's AMAT on the daily chart. And the reason I brought this up is a couple of reasons. Number one, you've got a cup and a perfect handle, breakout, retest, breakout. See, I mean, you need to study these because they happen all the time. It doesn't mean every time. Watch this. Here's a cup. No retest. Okay. Maybe here you could say, no. It just kept, it moved upward. Sometimes there's no retest. I like, these are the high probability, is the one that when it breaks out and it comes back and it retests structure and then it moves up again. Notice how this looks almost identical to the one that was in the presentation. Okay, so this is my favorite breakout pattern, is the cup and handle, because of the fact of the retest aspect. Gives you high confidence that that support level is held, that the buyers are there, that there's no supply, and so the demand is really hitting. So supply hits up here, you got some supply here, but they're still buying. Okay, so you had some bad news on these days, but it went right back into a cup, and again, you didn't really get much of a retest on the handle. I was pretty much trading AMET as a trend stock at that point, so I didn't really care. But now you got this big. This is more of a saucer. I talked about the saucer. Even though this was a saucer, you had the same thing. You had this big breakout. Draw your line here. Okay. And so here's my line. It broke it. The next day, it shot up. I don't trade this. A lot of people do. And a lot of times it's not going to come back. So that's fine. I want the high probability trades. If I'm going to be putting people onto trades, I'm going to give you trades that I see as highest probability. Well, what is the highest probability? Once it breaks the cup, I want a retest of this structure. All right, I want a retest of this structure right here. It flashed below it. It came back and closed. I would probably have given a mild signal to go ahead and buy here, but for the most part, I wait for this day to occur. Okay, and as soon as I see it break that right here, I'm going to go into the stock. Okay, so to me, this is a perfect example again of what I look for to call a trade. So and yes, the service, I'm going to be giving you these as close at real time or via text message. So I want you to be able to, since they're daily, there's some that will be intraday trades. Those will be giving at the very beginning of the day, because there's a lot of movement, market orders, and things of that nature that will have big block moves that we can make some pretty good money on. But in general, what we're going to be trading is more of either the stock, when to get into stock, or options, when to buy the options. And so I want to be the maximum move here. This sets up as a perfect stock entry for making an option call. Okay, so you would have been, I don't know what that move right there from 125. Look at this. I mean, 127.50 to, let's say this day, because this was what I would have gotten out, to 135. We would have had calls that were within this wick, because generally the wick gets taken out, right? I mean, if that was a signal down here, the wick's going to get taken out because it's a bullish trend. So anywhere in here is where your calls would be, okay? And your calls would have gone into the money. You would have been up 150, 200%, 250%, whatever percent. You don't be greedy. I wouldn't have even left a runner. Even if I would have had the next morning, I wouldn't have left a runner. It's a full candle day after 2 consecutive full candle days. That's a big, big move on a stock. It's a $10 move. I don't know what you want from trading, but if you can't make money doing it this way, then it's not the OA1 disciplined trading. It's more of Vegas trading. And I'm not in this for Vegas trading. I'm in this to make the money here. Let they got lucky, but most of them would have said, I'm going to wait. And they would have ended up at the same place, except the difference between selling into a rising stock at the same price of a descending stock is probably around 15%, meaning that the premiums will decline much more quickly, even at the same price on a descending stock. If the stock is the same price, but it's going down versus up, the options are going to be dramatically hit differently. I want to sell into a rising stock. So now sometimes if I did hold a runner, you'll hear me say things like, I'm selling at the open. So, and that's simply because I'm anticipating that I'm at a point of exhaustion of whatever I've been trading, and I'm expecting this, which is a reversal hammer candle that occurred, and then you get this retracement. If you're in the shares, you would have trimmed, but you wouldn't have gotten out. So that's the difference between trading shares and trading options. Options have an expiration time frame. I have to be more right on my options. My shares, if you're up $10, do you care if you drop $5? Well, yeah, you may care, but you're going to palate that a lot better than if I had held options from here to here. And then I'm like, I'm still in my options because they don't expire into here or something. Well, that's the same price as I could have gotten out anyway. And they're worth a lot less because of time value erodes them. Okay. So I could have bought options back here on this line because here's your 8-day EMA. The moment that it sold below this EMA line, and this is advanced stuff, I'm sorry, I'm giving it here. It went flash below it and it closed back above it. Okay. That is a very bullish signal that this 8-day moving average is being respected. I would have gone into trades here. I wouldn't have bought them at the bottom. I don't need to. I would have bought them here. Okay. And then this would have been a good trim day. That's a $2.50 move, guys. I mean, I don't know what you're expecting from market, but that's a pretty good move. And that would have set your options up 25 to 30% just right there. And so, trim, take that 25, 30%, because then when this happens, you don't care. Okay. You don't care so much about it on the pullback. But it pulled back and it dropped below the 8-day moving average. I would have exited the trade, even though this happened. I would have exited the trade. I would have re-entered maybe when it reclaimed it. But I don't like closing candles below the 8-day. If that's the reason I'm trading it, why would I not be disciplined when it violates it? Does that make sense? Closing candle below the 8-day moving average is a warning sign to me that I need to be cautious. So I would have been out of the trade. So now when it reclaimed it here, if I'm only trading AMAT, I probably would have bought again on the close above, because it closed up here. It closed above the 8-day moving average. Would have been a time to re-enter and buy again. And sure enough, you would have gotten repaid with a heck of a move the next day. $6 move. That's not bad. That's today. But I wasn't watching AMAT yesterday. My alert went off on it, and I wasn't here to do anything about it. So I missed that trade. But there'll be a lot more. So anyway, that's the last thing I just wanted to show you, because I noticed AMAT having broken out of this and created a nice trend going up here. And if I look back on the daily from where that reversal happened, you notice one more thing about the basics that I never did cover, which is a crime, because it's my main thing that I look for on a macro trend change. When I post that I think the markets have bottomed, for example, it's because I see this cluster of volume. When big money is moving in the market, they can't hide themselves. They show up on the chart. So they can't hide. And this right here, even though these are big volume days, if I took the total volume, and you'll see me a lot of times give you volume numbers and price target numbers. If the volume numbers aren't met along with the price target, I'm probably about 80% confident in that. If I have volume and my trigger price, I'm 100%. And very rarely am I wrong on those calls, because big money can't hide themselves. And once big money shows themselves, then everything is going to be very, very positive or negative, depending. Big money was showing themselves up here to be selling when you had the resistance that started this whole downtrend mess earlier of the year. They were showing themselves pretty good at getting out of the stock. That right here, these reverse Trixie moves, I call them, they like the markets are going to keep trending up and then they reverse hard. I don't think I shorted the market until it broke here. It had to break this structure. But once it broke the structure, I went in pretty good here. But when it came back and retested it and then lost it again, just like the cup and handle, here's a kind of reverse cup and handle. Okay. So as soon as it retested and then broke it again, you're having to think upside down. I like people to you can take this, copy, paste it, and then reverse the image, and you can see what it looks like upside down, but be thinking in bearish terms, and it really helps you visualize the negative cup and handle that's there. So anyway, all right, so that's the end of the beginner's basics. We'll be sending out the deck that then goes along with the presentation, and then we'll be gearing up for the advanced session. So if you guys have any questions, be sure and email them. Hope today was valuable and gave you some good information. Again, you had a heavy trend day today, so let me just give you this ending word of thought. You had a big day. You have the Fed Thursday. I'm not saying that big money doesn't use the uncertainty to try to make moves, especially if they're going to break this thing out upward into a bullish move and have a true bull market. Then tomorrow would be a great day for them to have a big long green candle, simply because everyone's going to be, hesitant after a big up day. The Fed is the next day, along with employment numbers. You have a lot of stuff coming Thursday. There would be hesitancy to be very aggressive tomorrow. So it would be a great day for the bulls to continue on. My sense would be that you're going to maybe get into some sideways and some choppiness tomorrow because of that. Maybe even a pullback of a percentage of today's move. But I don't know exactly what to expect because of how close you are to a breakout at this level. So better to wait for price action to tell us what to do right now. So CVS, by the way, where did it close? I'll give you this because I know a lot of you are in it. Let's take a look at CVS. CVS. This is what we would be doing at the end of every day anyway. Okay, so obviously, it broke our structure that we were really wanting, which was the 1, 2, 3. No, it was 1, 2, 3, 4. Today was day 4. Where did it close? 68.69. So we really need this to be back up within this trend line tomorrow, which is around 69.50. If we don't see 69.50 tomorrow, it becomes a little dicey. Even though that we're not, we took a good hit on them early, but then they came back. So it's not a big loss or anything right now because of the time value that's still in the calls. But I really want to see it show us something tomorrow. If it does, then I'm willing to hang in for another day at a rare 6th day, because generally this would be almost a tricksy move that is before a major breakout move. If that doesn't materialize, then that's not what it is, and you could get into one of these things, and we don't want to be in one of these things. Okay, sideways movement, watching our thing decay. Let's get our money out and look at some other opportunities. But yesterday would have been it's top of range yesterday, would have been a good trim day. I trimmed my dad's account. I didn't trim mine. But it's always fine to trend on the top side. I mean, it did touch the trend line, broke above it actually a little bit, and then it came back down. So when it touches the trend line, go ahead and trim, especially if you bought back in the day, here, anywhere, and it would have been positive. You would have been up something. You weren't negative, that's for sure. So go ahead and make a decision whether you want to trim sometimes on that. It depends on how many you have. I mean, I had 50. If I had 100, I would have trimmed 50. With 50, I just held it. And so I'm just waiting to see if it shows itself tomorrow. So tomorrow's a big day for CVS. A stock that I can't think of the stock right now that did make the move. I think, was it Zillow? I know I said that we need to be watching Zillow. Yeah, I mean, so here right? You have this resistance level that is right here, and Zillow broke above it. So I would like to see it come back and retest this. And if it does, we're going to be all over Zillow because it looks like a really strong breakout. It had a lot of sideways, frankly, almost it's not a conventional Darvas box, so I wouldn't call it a Darvas box. It's mainly been a sideways, choppy, uh, real choppy stock. So I hadn't had anything these are hard to trade. You may say, well, you could have bought here and made, well, good luck. All right. If that's how you think you can trade, I wish you the best, because in real time, that's not how these things look. So I need price action to determine what I'm going to be doing. We'll be talking about a lot of the interworkings of price action, market makers and things of that nature. Get under their skin, get under their brain a little bit, and boy, they'll really hate you. So I want to spread some of that hate. Don't let them just hate me, let them hate you too. All right. Appreciate you guys. We'll talk to you later.